Welcome to Market Monday from the investment team in the trust department at the First National Bank. As we're coming into the end of the year, the pace of economic data points being released is slowing down. But we have some highly significant releases coming in the next few weeks, and we need to be paying attention to them because the market is most likely going to be paying attention to these. Starting with the Consumer Price Index, which is set to release tomorrow morning. And on a month-over-month basis, the analyst expectation, or the consensus thereof, is 0.3%. And year-over-year, the consensus is 7.3%. It's worth noting that these numbers are high by historical standards. We're going to come back to that point later. But the Producer Price Index was released late last week, and those numbers came in hotter than expected. In other words, they reflect that the Federal Reserve's rate hiking cycle may not yet be having the impact that analysts thought that it was having on bringing inflation under control. That would imply that the Federal Reserve has extra work to do beyond what's priced into markets, and they could react negatively to hot numbers coming in on these reports tomorrow. The following day, probably the most important of all of the data points in the next few weeks, is the Federal Open Market Committee rate decision, which is expected to be a 50 basis point rate hike. That is a decrease from the recent pace of 75 basis points at each hike. So we will see whether or not that continues. It is widely expected to continue. However, up in the air now, because of recent data points, we have this concept that the Federal Reserve may have to continue the hiking cycle for longer into the next year, and potentially takes off the table any idea of lowering rates toward the end of next year, some of which is priced into markets. So again, markets will be looking for commentary related to this decision and determining whether things are changing at the Federal Reserve in terms of the outlook for how they're combating inflation and how long they need to stay as aggressive as they've been. After that, we're going to get information about manufacturing and sales. Sales obviously is important. It's the vast majority of our gross domestic product. We'll get labor market information, business outlooks. We'll get information on the real estate market and consumer confidence. And that is really key. They're expecting that to come in at 99.9. And if consumer confidence is remaining very elevated, that could be interpreted as inflationary, that meaning that demand is going to be very strong in the forward period, which would also tend to indicate that the Fed is going to have more work cut out for it. Alternatively, if that number comes in much weaker than expected, we would take that as a recessionary indicator that potentially consumers are growing concern and tightening the wallet. So that's another very important number. And we'll get information on the GDP growth for the Q3, which is expected to come in at 2.9%. Now, this is a revision. We're not looking for any major changes here. Obviously, the last time this number was released, it was released at 2.9% as well. But if there is a change, it will be indicative of whether the economy is a little bit hotter than expected or cooler than expected, which has bearing on the Fed rate hiking cycle. And then the leading economic indicator index, which has predictive power going forward, which is expected to come in at negative 0.4%. And this is telegraphing market expectations of a contracting economy, aka potentially a recession in 2023. Rounding things out with durable goods orders, people tend to only buy big ticket items when the outlook is positive. That's expected to show a contraction. That's also a recessionary type indication. And finally, the University of Michigan Sentiment Index, which has a lot of power. There isn't analyst consensus on that just yet, coming in ahead of the holiday. With all of that said, let's talk about the S&P 500 and its year-to-date. So year-to-date, we ended up, as of Friday's close, right around 18.3% down for the year. But that's about 12.8% up over the recent lows. And we've made some key milestones here. Back in June, there was a very nice bottom put in with big volume, and the market bounced up from there through August, where it trended down again, coming into October's CPI, Consumer Price Index release, where the market opened sharply lower and then quickly rebounded and made an upward move again. And we've just been treading water in this range. And we don't see a meaningful catalyst for it moving one way or the other if all of the numbers that are talked about just a few minutes ago come in relatively in line with expectations. The only time we would expect big movements toward the end of the year would be if there were surprises. So provided that we don't see any major surprises in the economic reporting, we're expecting the market to remain relatively flat through the end of the year. That's not always the case, but that does tend to happen as market participants step away from the desk and take vacation time, and there's just a lot less trading activity. Now, with that said, when there's less trading activity, that gives the potential for bigger percentage price moves when there is a catalyst. So we'll be paying attention, and if those numbers do come out in unexpected ways, we could expect exaggerated moves that might not necessarily be reflective of rational pricing processes, but more a function of lower liquidity in markets. Moving into the Consumer Price Index again, we said we were going to hit it again. Yes, the number is expected to be down here off of its peak when it comes in tomorrow, but it is at still extremely elevated levels that we haven't seen since 1980 or the mid-70s, or the Korean and World War II periods and the World War I period before that. So Consumer Price Index, measurement of inflation, is showing very elevated inflation in a historical standpoint. And that is why the Fed has been so aggressive. And let's talk about handicapping what the Fed is looking at. And this is what's called a dot plot. Each one of these yellow dots represents the outlook of a particular Federal Reserve member for a specific point in time. And as we can see, the gray is what the projections were as of June in that meeting. And then as of September, we have that in yellow, which is the latest. And uniformly, they've shifted up and shifted up for longer. So what we're looking at here is the potential, because we're still seeing strong inflationary type numbers and we still have a very robust labor market, there's a potential for the Fed to telegraph that rates are going to remain higher for longer and perhaps not start coming down as early into 2023 as was expected. So we've got our eye on that. And we'll close with corporate bond yields, because ultimately over the past few months we've been seeing very good, historically speaking, bond yields. As of now, 2-year paper is yielding about 4.7%, and 10-year paper is at about 4.8, 15 is 5. That is slightly down from what it was before. This is as the market is pricing in potential recession where rates might find a cap. But still, for income investors, this is a very positive situation. And with that, yes, this market has been turbulent throughout the years, and it's got its pluses and minuses in terms of allowing us to build bigger positions at lower costs if we're averaging into the market over time. And it's also been a bit frightening. We also have higher rates that are giving income to income investors. And over the long term, which we do this every time, but it behooves us to do it again, we're not as concerned with this chop throughout the year. We're taking a bigger picture context of the market, and our approach is to be in it for the long term and be long-term investors, not make changes to long-term plans based on short-term movements and ideas. If you have questions or concerns, please let us know, and we're happy to talk. Hope you've enjoyed this. Thank you, and have a great day.